Hi, I'm Jimmy. In this video, we're looking at some different ratios that can help us analyze a company. So imagine looking at a couple different, in this video, we're going to look at the efficiency ratio. And imagine looking at a few different ratios and being able to compare two or three different competitors to each other to see how operationally efficient that company actually is. And in theory, over the long term, ultimately having the more operationally efficient company give us much, much better returns. So here's the basics of how an efficiency ratio works. Basically, we take some line item from the income statement and we divide that by a line item from the balance sheet. The idea is to compare those two line items. Now, because the income statement covers a period of time and the balance sheet covers a specific point in time, we actually have to take the average number from the balance sheet. So we're going to introduce 4 different efficiency ratios that can give us insight, and we're going to show some actual examples and how those played out over time. Okay, so the first one's called inventory turnover. Now, basically, this is, well, you know what? Let's look right at the formula. The formula is cost of goods sold divided by the average inventory. So how much inventory are they buying and how much inventory are they holding? Now, the idea here is that you want higher turnover. So you want a company you want this number to be as high as possible. You want inventory turnover to be high. And the idea is that how many times throughout, let's say, the course of the year, does the company buy inventory and sell out of that inventory? Now, of course, in practice, they are hopefully always buying new inventory and keeping inventory in stock. But for the sake of this number, you can look at it as how many times do they buy inventory, completely sell it all, and then buy it back? We know that won't happen in practice, but that's kind of how you can think of this number. Well, when we jump into looking at an actual example, this is a chart of Costco's inventory. Now, for anybody who doesn't know, Costco is a retail company. A lot of times you can compare it to a company like Walmart or Target. Similar style businesses. They are brick and mortar retail businesses. And we can see when we look at each of their inventory turnover numbers over the past decade. So in this most recent year, you can see that Costco had an inventory turnover about 12. So about 12 times during the year, they completely sold out of their inventory. This is better than both Target and Walmart. Now, we can see that Walmart is second best, Target is third best. Well, if we look at the returns over the same time period, well, for Costco, for the past decade, they've averaged about 22% per year, average annualized return. For Walmart, the second best company on this list, well, they've put up about 17%. Then Target, who's had the lowest inventory turnover out of all of them, just 5%. So this one number a decade ago could have given us some insight. And if we were watching this through time, well, we might have an idea of where to lean. So this could be a good number for us to consider. Okay, now let's jump over and look at 2 different other efficiency ratios that we're going to kind of group together. And these are more around cash management. Here we've got receivables turnover and payables turnover. And the formula is quite simple. We take revenue for the company and compare it to either accounts receivable, average accounts receivable, or average accounts payable. It's really that simple. Okay, now let's look at a simple example with 2 different types of companies where these particular metrics are very useful. We're going to compare O'Reilly Automotive to Advanced Auto Parts. So this first one here is receivables turnover. Now, receivables turnover, one way to look at it is how fast you get paid from your customers. When you look at payables turnover, well, how fast do you pay your customers? Well, O'Reilly's the blue bar here, and Advanced Auto Parts the orange bar. Now, for receivables turnover, we want that number to be as high as possible. You want to get paid fast. For payables turnover, in theory, you want to pay them slowly. You want to hold on to that cash longer. So lower is better. So when we look at O'Reilly, well, we can see that O'Reilly has both lower payables, slightly, but still lower, but it also has higher receivables turnover, implying that they get paid faster and they pay out slower. So that cash management is crucially important to a company, to an industry where they have relatively small profit margins. Well, when we jump in and look at what the returns are, they're not even close. O'Reilly's up on average 20% a year over the past decade, just short of that. Advanced Auto Parts down about 10%. So O'Reilly beat them by about 30%. And that's at least partially due to their cash management throughout this entire process. There's other factors, of course, but this is an interesting number to consider. Okay, jumping back to our master list of efficiency ratios, we've looked at 3 now. We're going to jump on one more, and here we're going to look at asset turnover. So total asset turnover is exactly what you might think. Take revenue divided by average total assets. Well, one good example of this goes back to some of the retail stocks we looked at before, but here we're going to compare Costco to Target. Now, we already know what the returns are. We know that the returns were significantly better for Costco, but this is another number that we can put, another sort of arrow in our quiver that we can use to see how efficient is the company. And we can see that Costco has a brick and mortar business. Target has a brick and mortar business. So they both have a lot of assets on their books. But Costco, on a, let's call it per square foot basis, they are doing better. They are simply turning over their assets faster than a company like Target. And investors, if they paid attention to this, got rewarded for investing in a company like Costco over investing in a company like Target. So you can see that these efficiency ratios can be highly useful and take just a moment to do it. By the way, all the charts and all the data we have is over on the Investors Grow website. If you're curious, I'll leave a link in the description below if you want to sign up to get access to that. Now, one other point to keep in mind, and one other data point that's also on the website, is that if you take any of these data points and you divide it by however many days are in the period, so we were looking at annual numbers. If you were to divide, let's say, 365 by inventory turnover, that will give you the number of days it takes to turn over the inventory. So it could be one little trick if you're curious. Hey, they turn over inventory every, 25 days or 45 days, whatever it is. That's fairly simple math to do once you have these numbers. Now, coming out in future videos, we're going to be touching on some of the other categories of important ratios to consider when we're doing our analysis. The idea here is to make our analysis better, not necessarily more complicated. We want to be more efficient with our analysis. Thank you so much for sticking with me all the way to the end of this video. I really do appreciate it. Thank you, and I'll see you in the next video.